This is Michael Feng. I'm one of the co-founders of CoinAlpha. And today I'll talk about what we do and some of the lessons we learned in running a decentralized application that manages hundreds of thousands of dollars each day via an Ethereum smart contract. This is the title of our presentation. I'll spend the first about 10 minutes discussing what we do at CoinAlpha, and the second half talking about the lessons learned. At CoinAlpha, we're a team of technologists, former investment bankers, designers, and machine learning engineers. And so the problem we ourselves ran into when we started looking at investing in cryptocurrencies is that while it can be extremely lucrative, if you bought Bitcoin 5 years ago, held it to today, you're basically retired on a boat in Southern Caribbean. But in reality, I don't know anyone that actually did this, because while you could have made a lot of money, your monthly returns look like this. You know, the average return is 14% per month, but the standard deviation is 54%. So while there are many months where you're up a lot, there are just as many where you're down a lot. And that volatility, as an investor, is I can tell you from personal experience, is just gut-wrenching. Now, there are a lot of crypto hedge funds out there that have popped up. I think by last count, there's 120 of them. They charge a lot, pretty high fees. You have to put in about $100,000 to even get there, and you have to put your money in there for over a year. So they're really only available to large institutions, really rich people, and the privileged few. So what we decided to do was to try to make investing in cryptocurrencies safe, less volatile, and accessible to all. We do that with the combination of artificial intelligence and blockchain technology. Our first thesis is that AI can capture the upside of investing in crypto while minimizing the downside. So what you're seeing here is the result from our machine learning models. We try to classify the market into basically bull markets, which are the green portions, and the red parts, the bear markets, which are the red ones. So everything here is ex ante. So we don't use any kind of past future information to produce this data. We only use the past. And then we generate trading decisions based on that. And so we've run this strategy live for about 3 months now. And so far performance has been pretty good. We've been able to avoid some of the sharp drops in cryptocurrencies, like when China banned ICOs. We've done a decent job of riding the uptrend that has happened recently with the Bitcoin Gold hard fork and the 2x hard fork. And after the 2x hard fork was canceled and Bitcoin then dropped, we also avoided that downswing. So I think that, to be honest, this model is still a work in progress. We tune it every day, and there are many improvements we can make going forward, but the early returns are promising. We can use AI to essentially create a less volatile version of a crypto investment. The second thesis we have is that when you look at blockchain-based smart contracts, they're a really good proxy for how financial products are in the real world. Because a security is essentially simply an issuance of capital in return for some promise of something you get in the future. And we think a smart contract can replicate that functionality. To prove that out, we decided to show that we can do a better version of a hedge fund. In a normal hedge fund, there's many third parties involved that separates the manager and the investor. For instance, you have an administrator that handles fund inflows and outflows. You have lawyers that draft legal documents. You have a bank that handles wire transfers, and accountants and auditors whose job it is to basically make sure that things are what you say they are. Whereas, in a smart contract that's on the blockchain, where you have an immutable audit trail, a lot of the need for these third parties goes away. So to prove that out, we basically just went ahead and did it. So we launched a hedge fund called CoinAlpha Falcon LP, and essentially it uses an Ethereum smart contract to handle things like inflows and outflows, calculating the net asset value on a daily basis, and separating the gains and losses and allocating them to the manager's performance fees as well as to the investors' gains. So the advantage of this is that if you look at kind of like our terms versus the traditional hedge fund terms, we can offer much more liquidity and much lower minimums compared to other hedge funds. For example, we offer people daily liquidity, so you can get in and out the same way you can with an ETF or a money market fund. We have no lockup, and our minimum investment is 20 Ether or about $6,000 right now, which is much better than big guys. And so, our thesis is that like the benefits of active management and reduction of volatility should not be reserved for the privileged few. Instead, this should be available to everyone who invests in cryptocurrencies. And so we also have kind of like a web-based interface that helps people, like see what the positions are, learn about the fund, see the performance, and so forth. The cool part about this is that we don't really have a database. All the data that comes in our web app is coming from the blockchain itself, because the blockchain is really our backend. And in the future, we feel like we offer people a compelling solution that's somewhere between kind of like the DIY approach, where you deal with the security issues, you manage yourself, and you're exposed to volatility. And on the other hand, these like large hedge funds that are very exclusive, offer high fees, and you need a lot of money to invest into. So that's kind of like our what we do as a company. And now, if there's no more questions, I'll move on to what we learned by actually doing this. Let's check questions. No questions so far. Awesome. So what did we learn by doing this? So generally, we think that we have one of the more complex smart contracts on mainnet right now. Unlike, we had to kind of create a lot of things because most of the templates we found out there were for ICOs, which we are not. So the first thing we learned is that users don't care about decentralization. This is a kind of schematic about how our smart contract works, but the main thing to look at is we don't decentralize everything. What we don't decentralize is how we actually perform trades. This is not a decentralized autonomous organization where the crowd is making decisions. We found that fund investors want someone who knows what they're doing to manage their assets. And in addition, we don't rely on decentralized exchanges to perform trades. We trade at the top centralized exchanges in the US, namely Gemini and GDAX. And the reason for that is that the decentralized exchanges simply don't have the liquidity right now to handle large flows of capital. I believe that the daily volume on Radar Relay is around I think $10,000 per day, which is simply insufficient for a hedge fund. So we look at it in terms of decentralization is not an end in of itself. Instead, users care about the benefits that decentralization offers, and they weigh them against the trade-offs. So the benefits are, lack of intermediaries, more efficiency, more transparency, and the trade-offs are that it's something very new and unfamiliar. And so, when we think about decentralization, obviously it's a goal for us to be very decentralized in the long run as an end state. But getting there is a series of kind of compromises that where we need to offer value to investors today. The second thing we learned is modularity is very important for smart contracts. Smart contracts are immutable. What that means is that when you deploy a smart contract onto the Ethereum blockchain, you can't ever change it. That can be problematic when you have a fund that might live for 10 or more years. There may be changes to the fund. We may discover a vulnerability we need to fix. We may want to upgrade certain components of the fund. And so to do this, what we decided to do was create a single smart contract that acts as the gateway for investors, and that's what's called the fund smart contract. And then we delegated the logic of the smart contract to some modules that handle all the calculations, calculate all the balances, and those submodules can be upgraded or fixed as the need arises. Now, for those of you who are a little more technical, this is a very similar approach to what Parity used with their multi-sig wallets. And one of the reasons, basically the reason that broke in basically about $200 or $300 million in Ether is frozen right now is because they did not make their modules what I call hot swappable. What that means is they also defer the logic to subcontracts in order to save on gas. But because the references to the subcontracts were hard-coded in the main contract, when someone accidentally removed one of these modules, the main contract could not recover gracefully. So I think we have done a better job of addressing this, and the code is here in terms of how we do that. Essentially, what we do is we set a pointer to both the submodule in the main contract, and we also set a pointer to the main contract from the subcontract. What that means is if the submodule goes away, we can spin up a new one and reset the pointer on the main contract, and vice versa in the subcontract. If anyone's interested in how this works, this is what it looks like. I published the link to the GIST below. It's public. Feel free to take a look at it. And if you find anything, please let me know, because that we need to fix. Because for us, we always we recognize that security is an ongoing concern, and if anything, kind of like any vulnerabilities arise, we want to know about it. The other thing we learned is how important operational security really is. So for us, we essentially need to update our fund every day for people who are putting in money, people who are withdrawing money, recalculating the value of the net asset value of the portfolio, which dictates the prices at which people are entering and exiting. And so hundreds of thousands of dollars worth of value hinge on the operations of our smart contract on a daily basis. And so we've figured out kind of like a model for how to do this efficiently, but also securely. So what we do is we have an administrative account that we use to manage our fund. That account is only available in a hardware wallet. We use a Ledger Nano S that we have somewhere in a secure location, and then we use that in conjunction with the Parity client. The Parity client allows allows an address to control a smart contract, and the nice thing is that the Ledger and Parity work very well together, such that you can only perform the functions you need on a smart contract if the ledger is physically present and you've activated the passcode. And so there's a couple layers of security there that prevents anyone from hacking us, because there's no access to anything we're doing if you don't have the combination of these things. In addition, we also use a very secure safe in order to ensure that the hardware wallet is not compromised. And we also take advantage of security boxes, safe deposit boxes at our bank in order to ensure even more security. So there's a lot of, I think that generally speaking, there's right now there's kind of like a segmentation in the market between kind of like what people call cold storage and hot storage. I think that because when you're managing a smart contract on a daily basis and you're interacting with it all the time, in order, you can't really have hot or cold. You kind of have to have a solution that mixes the best of both worlds, and it's something that I think we've figured out. Now, the third thing the third or fourth thing we've learned is really around the user experience. So let me walk you through an example of what I mean. So what you're looking at here is our web dashboard. So this shows my personal holdings in our fund. So you can see that right now I have about $28,000 invested. It's gone up about 6% since we launched, which is pretty good. And I can either add more Ether or I can redeem Ether at the share price on a daily basis. And so this is intended to give people kind of like an E-Trade, Coinbase kind of experience that's very smooth. And not to foreshadow anything, but unfortunately, we're just not there right now with the kind of the Ethereum and dApp ecosystem. So I'll show you kind of why. So let's say I wanted to add more Ether into our fund. So I'm going to click here and hit the subscribe button and tell our app how much I want to add. So this is the next screen that pops up. And what you're looking at here is a Chrome extension called MetaMask that we use in order to allow people to interact with a web app. Ignore this insufficient balance thing. That's because I'm doing this as a test. But as a product manager, there's a good amount of user friction between the kind of like looking at an application and then having a Chrome extension kind of pop up with a different UI and where you're not sure what's intended to do. And so that interaction right now is unfortunately unavoidable in terms of like where the state of the market is right now. The problem is even a bit worse when someone wants to redeem. So let's say I hit this redeem button, which means that I want to take some money out of the fund. So when I hit redeem, I see the same MetaMask transaction. And when we first kind of walked our investors through this, a lot of them were very confused because they said, well, I want to take money out, but why does it look like I'm sending ETH into this dApp? And so we have to explain to them that no, you need gas in order to issue a transaction on the Ethereum blockchain. And the question was, how do I know I'm sending to the right address? And the confusion was very apparent. And so, our main takeaway from this is that right now the end user dApp ecosystem is very nascent. The reason I think that not a lot of decentralized applications are being adopted is because the tools that are available for people to interact with them, the smart contracts in particular, don't really exist. And when I think about when we want people to be their own bank, that's a very noble theory, but those people also need the tools to safely and comfortably interact and really be their bank. And so there's one thing that I think an ecosystem I would love to see more of. It's a creation of tools that allow end users to interact with decentralized applications. So I'll stop there. I think there's about 20 minutes left. We'd love to take any questions or not. So one question someone had was on the legal side, how are we set up? So that's a great question. So we spend a lot of time on this. And in fact, I think we spend more time on the legal part than the smart contract technical part. So what we did was we used, so our lawyers are Oric, they're a large law firm based in San Francisco. And we work with them to create a legal structure that looks and feels just like a normal hedge fund. So we comply with all the regulations that are in the 1933 Securities Act, the 1940 Investment Company Act, and other regulations because we simply just follow the same rules as a normal hedge fund. We did have to make some tweaks to accommodate the acceptance of capital via Ether rather than dollars. But the way that we look at it is the smart contract doesn't replace the legal contract. Perhaps it will 5-10 years from now. But right now, in order for the smart contract to exist side by side with the legal contract, essentially what we've done is we view the smart contract as a replacement for the administrator, the custodian, accountant, and auditor in the transaction. It doesn't fully replace the need for a private placement memorandum or a limited partner agreement. The main law firm is Ulrich, Harrington, and Sutcliffe. So regarding the SEC and the blockchain, our view, the view we took is that a lot of the debate has been around, what is a utility token and what is a security token. Because our token represents a share of the profits made by our hedge fund trading strategy, it is a security by any letter of the law. And therefore, when we looked at kind of like the value of having a token, it wasn't necessarily to get it out to retail investors or make it basically allow people to kind of like invest who really shouldn't be so. We still only market our fund to accredited investors, but we view that the value of having a token is that it allows the back end to be a lot more efficient. Allows people to trust that they're paying lower fees because there's less intermediaries involved, and that they can see every transaction that happens on the blockchain, and there's a replayable audit trail. So it would be impossible to have a Ponzi scheme like what happened with the Bernie Madoff hedge fund a few years ago. And so we feel like the advantage is really in transparency, efficiency, and liquidity. So another question that someone had was, any tips for a newbie wanting to get their feet wet with a $500 investment in blockchain? So I think as a long time kind of like cryptocurrency investor, my recommendation would simply be to buy, maybe Bitcoin, or if you want Bitcoin, Ethereum, and Bitcoin Cash, and don't look at it for about 5 years, because I think the long-term value of the ecosystem is definitely present. There's a lot of short-term volatility, and what we help people with is managing the volatility. But because based on regulations, we can only accept accredited investors. We try to lower the minimum, but it doesn't change the profile of people that we accept. So someone asked, do we benchmark against Bitcoin price? Yes, that's right. So the way our strategy works is that we use AI to try to predict where prices will go in the short term, given where prices are today and in the past. This is very similar strategy to how hedge funds in the commodities world were able to make a lot of money in the 1990s and 2000s when the markets were relatively nascent there. Similarly to commodities, cryptocurrencies trade primarily in technicals, not fundamentals. And so we essentially apply the same style of strategies, but we use modern machine learning methods to identify indicators and classify markets rather than drawing charts or relying on simple indicators like MACD or RSI. So one question was, can we use IRA money to buy cryptos? Yes, I believe so. I think that there is there are some, I have seen some IRA companies out there that allow IRAs to buy Bitcoin. Unfortunately, I don't know much about them. For us, our initial target audience are really people who are accredited investors, who have some knowledge of Bitcoin and Ethereum, but and they want to avoid that volatility, but they also don't have like the millions of dollars necessary to invest into a crypto hedge fund. And so for us, it's really that sector. One more question. What is your view on the privacy sector, privacy coin sector, and how do you account if you trade Zcash? So currently, we take a purely technical approach to trading coins. And so because we don't trade we actually only trade Bitcoin, Litecoin, and Ethereum right now. We probably will add additional coins as we develop, including Zcash. But because we take a purely technical view, we don't have a view on fundamentals at all. There's definitely foresee a point later on when we add a more fundamental strategy. But right now, we're really focused on 2 things. First is improving our AI-based algorithms to help people minimize volatility in the basic currency trade right now. And number 2, making it easier for people to actually invest in our funds. Whether it's by opening up to people outside the US, to retail investors, or improving the user experience of investing into an Ethereum blockchain-based product. I think I've kind of handled most of the questions so far. The one thing I wasn't going to go into detail on, but I figure since I have 10 minutes is really why we're doing this. To kind of give you more insight into myself and my team. So there's 3 founders. We have combined on the team about 20 years of experience in investment banking. We have lots of experience in machine learning and AI. We also have lots of experience in smart contract and blockchain development. My co-founder just won the Consensus Academy hackathon in Dubai a few weeks ago. So we're doing this not because we feel like we want to make oodles of money managing a hedge fund. Obviously, that's kind of a one attraction. But we're doing this because we really believe in the ability for blockchain technology to change the financial services ecosystem. The traditional world is very tied down in the way that they process capital. Having worked at places like Citi and JPMorgan, I can tell you that there's so much money and people and time that simply goes into making sure that things went correctly, that payments were made, that the payments were calculated correctly, and managing a chain of intermediaries that basically all the jobs do is to move money around. It's horribly inefficient, and the blockchain has a single source of truth, especially when you factor in smart contracts, which encapsulate logic onto the blockchain, can significantly make an impact on that ecosystem. And this is not a new thesis. Companies have had this thesis for a while. In fact, companies like R3, Hyperledger, Digital Assets, and Chain raised probably combined $300 million over the past few years to pursue that thesis in traditional markets by creating private blockchains for them. It's been about 3 or 4 years, and they're still in the pilot stage. And that's because when you have traditional systems with many different participants, and it kind of sort of works, there's very little incentive to change. And so we decided to take a new approach, which was, instead of trying to convince traditional hedge fund to adopt a blockchain-based fund administration system to handle their fiat assets, we decided to create a new exemplar of what that new model looks like in the crypto world. So we view our first crypto hedge fund that's blockchain-based as simply the first version of a series of blockchain-based securities that we can launch on a platform, whether it's funds, derivatives, asset-backed securities, and anything where you have flows of capital and you have logic that governs how that capital is used. So given the lack of questions so far, I think that it looks like either I've satisfied everyone's search for curiosity and knowledge, or no one's paying attention. Hopefully it's former, but either way, if you have more questions, I'm happy to chat. You can email me. That's probably the best way. My email is mike@coinalpha.com. One more question. Can you please go over again how AI helps lower volatility? Sure, I'd be happy to. So the great thing about Bitcoin and Ethereum and other digital currencies is that there's tons of data. You have the blockchain itself. You have about 100 different exchanges around the world where cryptocurrencies trade. Most of them have an API that gives you access to historical intraday data as well as the current order book. So there's a lot of data available, which is always great whenever you're dealing with AI or machine learning. On the other hand, you have a lot of decisions that people are making today. So right now, if you look at where Bitcoin prices are right now, are they high or low? Is a trend going up or down? I think all of us, if you stare at the moving ticker for Bitcoin and Ethereum long enough, you're processing kind of the numbers in your head, and you might make a decision. I'm going to buy. I'm going to sell. I'm going to set a limit order and buy when the strategy hits X. And so for us, we believe that if the combination of data and decisions that humans are already making, by looking at numbers, really are better made by a machine. And so we have a couple classifiers in the model. We classify based on momentum, whether the market is going up or down, and we classify based on mean reversion, whether the current market is oversold or overbought. And we use those models to generate a trading decision based on that. And so far, it seemed to work. We've run the strategy live with our own capital and our investors' capital for the past 3 months. It's avoided the big drawdowns, and it has delivered, it's captured most of the upside. It's not a magic bullet. You're not going to get all the upside with none of the downside. But we think that to mitigate the downside and capture most of the upside is a strategy that appeals to investors and helps them sleep better at night. 2 more questions. It looks like one is, what's our strategy against drawdown risk, and what's our average hold time? So our strategy against drawdown risk is pretty simple. When our bot believes that we're entering a bear market, we sell the cryptocurrency and we hold dollars. So essentially, we have a different model for every cryptocurrency US dollar pair. So Bitcoin dollar, Ethereum dollar, and Litecoin dollar. In each bot, the bot makes a decision based on where the current markets are, whether to buy or sell and hold dollars, or conversely, sell dollars and hold crypto. We generate a new prediction every 15 minutes, given the data that's coming in, and we trade based on that. Average hold time differs by currency, and as well as how volatile the current market is. For Bitcoin, our average hold time has been around 7 days. And so sometimes, in the past run up to, kind of like the Bitcoin gold to the SegWit kind of like announcement time frame, basically we held it for 2 weeks. But that's because every 15 minutes during those 2-week period, the indicators told us that the market was still trending upwards. But in periods of high volatility, for example, after the SegWit, after there was an announcement that it was canceled, then our bot would tend to trade more. We're also, hold times are also lower for more volatile markets like Ethereum and Litecoin. So another question is, are those decisions to hold longer human or bot made? They're entirely bot made. We do have human inputs right now. We have a human kind of like fallback, but that's more because our model is not complete. There is a bunch of kind of like heuristics that we are encoding into the model, for instance, like stop loss, those kind of things. A lot of the more sophisticated strategies are ones that we're basically implementing ourselves right now, but they eventually will be encoded into the bot as well. So I'm kind of running up against my time slot, so I want to kind of be respectful of all the other talks that are going on today. I hope that this was helpful in terms of what we do and some lessons we learned. If you'd like to learn more, don't hesitate to get in touch. My email is mike@coinalpha.com. You can also find me on LinkedIn as Michael Feng. Just mention that you listen to my talks, so I know how to connect.